For years, American homeowners have only had a few options when it came to financing their home. As a matter of fact, you may think mortgages have been around for hundreds of years. After all, how could anyone ever afford to pay for a house outright? It was only in the 1930s, however, that mortgages actually got their start. It may also surprise you to learn that banks didn't forge ahead with this new idea. Insurance companies did. These daring insurance companies did this not in the interest of making money through fees and interest charges, but in the hopes of gaining ownership of properties if borrowers fail to keep up with the payments. Not really the best business model, but that's how it got started. It wasn't until 1934 that modern mortgages came into being. The Federal Housing Administration, FHA, played a critical role. In order to help pull the country out of the Great Depression, the FHA initiated a new type of mortgage aimed at the folks who couldn't get mortgages under the existing programs. At that time, only 4 in 10 households owned homes. Mortgage loan terms were limited to 50% of the property's market value, and the repayment schedule was spread over 3 to 5 years and ended with a balloon payment. Yikes! Talk about pressure. An 80% loan at that time meant your down payment was 80%, not the amount you financed. With loan terms like that, it's no wonder that most Americans were renters. Before FHA, traditional mortgages were interest-only payments that ended with a balloon payment that amounted to the entire principal of the loan. That was one reason why foreclosures were so common. FHA established the amortization of loans, which meant that people got to pay an incremental amount of the loan's principal amount with each interest payment, reducing the loan gradually over the loan term until it was completely paid off. Not that long ago, there was only one type of mortgage offered by lenders, the 30-year fixed-rate mortgage. A fixed-rate mortgage offers an interest rate that will never change over the entire life of the loan. Not only does your interest rate never change, but your monthly mortgage payment remains the same for 15, 20, or 30 years, depending on the length of your mortgage. The only numbers that might change are property taxes and any insurance payments included in your monthly bill. This is not a bad loan, but it is the most expensive. This is where adjustable rate mortgage loans come in. We call them ARM loans. An adjustable rate mortgage, ARM, has an interest rate that changes, usually once a year, according to changing market conditions. A changing interest rate affects the size of your monthly mortgage payment. ARMs are attractive to borrowers because the initial rate for most is significantly lower than a conventional 30-year fixed-rate mortgage. Even in 2010, with interest rates on the 30-year fixed mortgage at historic lows, the ARM rate is almost a full percentage point lower. ARMs also make sense to borrowers who believe they'll be selling their home within a few years. It's also the least expensive loan available in the market today. Why? Because with adjustable rate mortgages, the interest is calculated on the remaining balances each month. So you might keep it for 30 years, but you will pay tens of thousands of dollars less in interest over the same period as a standard 30-year fixed mortgage, where the amount of interest you pay is fixed and will not change, even if you make bigger payments. Fast forward to 2015, and behold, you now have the new all-in-one loan. Nowadays, the average homeowner or home buyer has your standard all-American checking account with any bank that you can think of. You put money in and take it out as you need, and round you go forever. Then over in the bills column, you have the biggest loan you will ever have in your life, your mortgage. Blah. Will that thing ever go away? Well, according to many economic reports, no. It's not because people love having a mortgage, it's because life gets in the way. College, sports teams, braces. Man, those are expensive, as I just learned. Car breaks down, vacations, simple ones, not round-the-world cruises. And I'm sure you could all add another 10 things to the list. No big deal. Hey, it's life and we all signed up for it. Sort of. Okay, you were recruited by your parents. They signed you up for it. Either way, you're here. As you can see, a lot of money goes to the mortgage each and every month. But imagine for a moment if you could combine your checking account with your mortgage. Yes, it's true. For the first time in the United States, there is a revolutionary new loan that will change the financial landscape of every homeowner out there, at least the ones with a mortgage. Don't worry, that's pretty much all of us. Okay, that's great, you say, but why would I care? The reason is simple. With the all-in-one loan, you will be able to pay off your current mortgage, no matter the size, in approximately 12 years. That's right, 12 years, even less in some cases, and with no change to your current monthly budget. That's right, you don't have to stop going to Starbucks. And you don't have to make your own clothes out of wheat or go draw water from the river. Let me explain. Pay attention now. Let's create homeowner Harry and Sally for a minute. These guys are everywhere. Same hopes and dreams and fears. They know owning a home is the best way to build a future, and it's way better than paying rent, but it's also for 30 years. #yikes, that's a long time. But hey, they want the American dream, so they push on. Okay, they bought their home, and their loan balance is, let's say, $400,000. Their monthly take-home salary is roughly $6,000. Basic monthly expenses hover around $2,500 a month. They have an all-in-one loan, so Harry and Sally deposit their monthly income into this checking mortgage account. So what happened? Well, essentially, Harry just paid down his mortgage $6,000. Yes, he will draw out $2,500 as the month goes on to pay expenses, but his mortgage payment is already paid. The minute his check hits the account, his payment is already made. Now, because this mortgage is essentially a home equity line of credit, his payment will not only continue to go down each month, but as you can see in the credit available column, the amount of money Harry and Sally will have access to each month grows each month. And this is just the first 6 payments. Remember, this is like a checking account as well, so you will get a debit card and checkbook, along with the usual monthly statements. Let's look at the end of the 3rd year. Wow! Harry and Sally are totally amazed. And again, no change to their current lifestyle or spending habits. As you can see in this chart, we get the big picture. They will pay off their mortgage in 11.67 years. They only paid $87,260 in total interest. And yes, it was still tax deductible. Remember, as he made his $6,000 deposit each month, the principal balance kept getting smaller, so less interest could accrue on a month-to-month basis. That's one of the biggest advantages of any adjustable rate mortgage. The other huge benefit of this all-in-one program, if you haven't figured it out yet, is you still have access to all that equity. See credit line available. On the standard 30-year fixed loan, as you can see, Harry and Sally would have had to pay $308,393 over the next 30 years. Wouldn't you rather have that invested for 20 years? Talk about a nice retirement. So finally, after only 11 short years, or 140 payments, they are free and clear, and they still have access to the $402,732 for anything they might need. Can we say college? How about buying a rental property all cash and collecting rent each month that can go right to the balance on this new loan and have that paid off even faster? Or pull the money out and buy a fixer-upper all cash and flip it. Make even more money. Or give a nice gift to your favorite charity, church, or philanthropic interests. Bottom line, you now have control over something no one has had any control over since 1930. Oh, and just as a side note, this loan has been available in Australia, Europe, and Canada for decades. These countries don't have tax advantages for having a mortgage, so there is no real benefit to having a mortgage for 30 years. So they just try to pay it off as soon as possible. Makes sense. But now you have access to one of the most powerful tools in the financial industry. I'm sure by now you have tons of questions. And yes, there are certain requirements to qualify for this program, so please just reach out to me, and I will be glad to go over anything you would like. Yes, for free. Look forward to hearing from you soon. My direct phone is 949-246-0633, and my email is mike@mikelending.com. You can also visit my website at www.mikelending.com. Thanks again for your time.